Let's talk about SoFi's a big weapon. It's something we've talked about before, but it's something that rarely gets mentioned and its potential could be extremely big. Now, SoFi, that rhymes. So far, SoFi has really been underperforming, right? For most of the investors, year to date is down 30%, but most of us probably bought or have an average that is a bit higher than the price we're at today, unless you're one of the lucky few where your average is closer to $6 or so. Now, currently, the company has a market cap of $7.3 billion, forward PE 63.4 times, but to be honest, you shouldn't really be looking right now at the PE of this company. In the future, 100%. Now, if we look at what the company has done since 2020, well, revenue has increased 390%. Gross profit has increased 515%. If you look at SBC as a percentage of revenue, it's now at 11.69%, so definitely much better than before. But of course, overall, if you look at net income, this is in the last 12 months, we're still unprofitable, but that will change in the coming quarters as the company becomes more and more profitable. Now, when will the stock react positively? Because as you've seen, the company has been doing quite well, growing quite fast. So what the heck is going on? Why is this stock not moving? Well, it has also to do with the fact that the market still thinks that the majority of its business is focused on loans. Loan forgiveness is hurting the company. There was a pandemic, high interest rates, etc., etc. All of that is hurting the company. Well, yes, but it's also benefiting from a high interest rates environment. Of course, when interest rates will go lower, it will benefit as well. Now, we've been talking about SoFi for quite a while. I'm not here going to tell you that, oh, tomorrow the stock is back at $10. No, but I do believe that next quarter is going to be yet another good one, another good execution. Guidance, let's see if they raise it, because last quarter, yes, guidance was a bit light, and so the stock got punished. But overall, management has quite a good track record, other than, of course, the stock price not being up. The business has been doing extremely well. Now, if you're fully focusing on management's track record of a stock's performance in the short term, then yes, maybe you should give them an F. But if you're looking at what the business has been doing, I think they deserve a B or an A. I don't know what it is in percent, but I would give them definitely an 80 or 90% on 100. Now, despite what a lot of retail investors might think, the market overall on average is still quite bullish on the stock. The average price target sits 25% higher than the price we're at today. I know most investors would like to see over $10, but hey, step by step. And if we're looking at what the analysts are expecting for the coming fiscal years, they're expecting sales growth of around 17% or so on average each and every year. And then EPS growth that of course will grow much faster, 193% growth for fiscal year 2025. And then another close to 100% year-over-year growth in fiscal year 2026, bringing EPS to 43 cents. Of course, we've talked about what management are expecting by 2026 and their growth after that as well. So if those are the numbers and we're still staying at $7.3 billion in market cap, yes, I think it is quite cheap. Of course, you might disagree. You might think this is a meme stock, SPAC, shamat, you name it. Okay, fine. Then don't touch it. But for those of us that are long-term investors that do believe in this company's future, I think this is an opportunity. And I'll talk about the, inside company that always gets overlooked, and that's Galileo. More on that in just a second. If you're new here or if you're a recurring viewer but you're not subscribed, hit that subscribe button, like, notification bell on, do all of that. Would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, more recently, there was an interview with the Galileo CEO because, yes, despite it being a company that SoFi has acquired, they've always said that they're going to operate it a bit separately so there is no conflict of interest. So there was an interview with Galileo's CEO. Tevis has shared that as well, but I'm going to touch on a couple of points that were mentioned. First up, for those that don't know, Galileo is a leading financial technology platform that provides the infrastructure for building innovative financial products. Think of it as the engine that powers many of the financial apps and services you use today. So there are 4 things here that they can do: core banking platform, card issuing, payments processing, open banking. So they support open banking initiatives, allowing for secure data sharing and innovation. You might ask, how do they make money? Well, again, a couple of points here. 1, platform fees. So they are recurring fees based on the number of accounts, transactions, and other usage metrics. Transaction fees: Galileo might charge a fee for each transaction processed through their platform. They can also generate revenue from card issuance and management services. Last one here, value-added services. Additional services like fraud prevention, data analytics, or customer support might come with separate fees. So when we talk about SoFi, when we talk about the fintech space, it's true that it's a space that might be extremely saturated, new players, etc., etc. Okay, so SoFi has to compete with them. But on the other side, you've got Galileo, which benefits from a lot of new players and also legacy players that want to modernize the way they work. And this is where the next part of the video comes in. So the current CEO of Galileo is called Derek White, was previously the Vice President of Global Financial Services at Google Cloud. Before his time at Google Cloud, he had a distinguished career in the financial services industry, including roles at US Bank, BBVA, Barclays, and he also served as the technology ambassador for London. So quite some experience. For those that don't know, last quarter, Galileo accounts totaled 151 million. That's up 20% year over year. And you can see a clear reacceleration since Q1 of 2023. Now, let's talk about a couple of things that he mentioned during that interview. So he talked a lot about the glass concept. So you have above the glass, the consumer-facing experience. This includes the user interface, digital channels, and interactions. Then you've got below the glass, the underlying technology, infrastructure, and processes that enable the customer experience. He said that the pandemic accelerated the shift to digital banking, highlighting the importance of a robust digital platform. We've seen that with the rise of Robinhood, Revolut, and even Nubank or Mercado Pago, to name just a few. Now, what are the challenges in the digital transformation? Well, you've got siloed business unit. Traditional banking structure hinders a holistic customer view, not just from a product perspective, but also from a financial perspective, meaning every segment of the business is being led by different managers. All of them have their own P&L, and so nobody really works together or has any idea how well or how bad the interactions are. The prioritization of products over customer needs leads to fragmented experiences. And then the last one, of course, legacy systems, outdated technology infrastructure restricts innovation and agility. And this brings us to the DIY metric, the do-it-yourself metric. The definition here measures the percentage of customer tasks that can be completed independently without human interaction. It indicates the level of digital maturity and customer self-sufficiency. How do you do that? Well, compare DIY scores to industry peers to identify areas for improvement. You can try it yourself with your own app right now on your cell phone. How many things can you do yourself, and how many do you have to actually contact an agent, a digital one, or by phone, or go in the office? You can try it out yourself. Maybe write it down in the comments below. Then a quick note on the evolution of banking. So you've got the age of brick. Physical branches as primary customer touchpoint. Then the age of glass, digital channels become dominant with online and mobile banking. And then the age of air, AI-powered, voice-activated interactions and personalized experiences. This is where we're going. And so AI's role in banking will become bigger and bigger. AI can analyze customer data to predict preferences and behaviors, automate routine tasks, and provide proactive solutions, because that's the whole thing, right? You want it to be proactive. So before you even log in to the app or go into the app and ask a question or search for something, you already get the notification. The action has already been done, or at least you've been aware of it. And the last one here, tailored product and services to individual customer segments. I mean, if you go and watch the interview, I'll link the Tevis video below. It can really go extremely far. And to be honest, it's about time our relationship with our finances and our bank becomes better, easier, and more personalized. You can really go quite far with it. And so then you've got the question of banks versus big tech. So big tech companies are expanding into financial services. We've seen that with literally close to every single big tech company. Banks benefit from established regulatory frameworks, of course, and then banks have a strong foundation of customer trust and data. I don't know about trust, especially not more recently, and of course after 2008. But yeah, okay, I can understand that they have a lot of data. But then again, so has Apple, so has Amazon, so has Alphabet, and well, Nubank, Mercado Libre as well, again, to name just a few. But I've spoken about this in the past. What if Amazon suddenly offers financial services, banking services, right, as part of the Prime membership? Would you not trust them? Do you think Amazon will go out of business? Do you think Amazon will have a cash issue anytime soon? I think I'll trust Amazon, and I'm sure I'll have a better experience with Amazon than with my traditional bank. Maybe that's just me. And so the key takeaways and recommendations: prioritize customer needs and experiences, invest in technology and infrastructure to support innovation, leverage data to understand customer behavior and optimize offerings, break down silos and foster collaboration, and the last one, embrace AI to enhance customer experience and operational efficiency. And this is basically Galileo and SoFi's big weapon, big secret, maybe not so big secret, but definitely a big weapon. This is how I believe SoFi will win. I think Galileo in the future should become bigger than what SoFi is today, because as we move towards either a lot of new neobanks, fintech players, or just the huge banks wanting to digitalize, wanting to become maybe friendlier, AI embracing financial institutions, they're definitely going to need something like Galileo. Now, management has been talking about, well, legacy customers, etc., etc. We are yet to hear who that big whale is. So remains to be seen who that is, when that happens, and of course, how big of an impact it will have on the overall business. And so before ending this video, right now we're sitting just under $7. The 200-day moving average sits at $7.40, the 50-day one at $6.84, and the 20-day one at $6.55. RSI is pretty neutral. Now I did draw a couple of lines here again. This is not a Picasso painting or something. This is just me looking at what I'm seeing and basically showing you as well. So previously we've had a period where the stock was trading between those two areas right here, $4.40 and approximately $8 or so. And then we went up around 128%. Then we traded also between $6 and something and $10. We're up and down, but mostly down. Now, let's see what happens with the next earnings report. Are we going to see the same move up, which means another 130% move, which should bring us at around $14. Now, of course, that move might not happen in 1 day, 1 week, or 1 month, but hey, these are the patterns that I'm seeing. Do with that information what you want. Again, technical analysis is here to help you a little bit. It does not predict earnings or a black swan event or whatnot. So overall, that's about it. I think Galileo is getting overlooked by a lot of folks. By the way, institutions have been buying into SoFi while retail has been selling. We've seen that in the past happen with other stocks as well. But hey, let's see. A couple of weeks left, and then we're getting the earnings report, earnings call. Let's wait and see what management has to tell us. I'll have a follow-up video with regards to the Anthony Noto interview that apparently freaked out some investors, so stay tuned for that. Leave your comments down in the comment section below, like, subscribe, do all of that, and I'll see you all in the next one. Bye bye.